think of 100 baggers as a clickbait. If you end up with a 50 bagger, you won't be disappointed, or you won't be
Yes.
really feeling sorry about it. But all I'm giving is 5-7 a framework which you
Yes.
should use. But I think more than the framework, it is your own behavior, your own ability to absorb it, believe in it, and stick around. But there is something which actually came up very strongly. Attributes to look for, or the red flags, because all the attribute you look for, and there will be a red flag or a corresponding red flag around it. For example, look at a runway. Think of early 2000 and you are buying Airtel. When everybody thought that this 15 rupee call will not materialize, or it will actually be a barrier, and thinking that without all the peripherals you can I had to wait for 10 years to get a telephone connection. To think, and most of the time we think in static terms, that things will not change. Everything changed. Today the speed at which we talk. You remember the initial SMS days when on
Yes.
Diwali people used to charge you 10 rupee per message. It is quite a laughable thing today. But look at the revenue, look at the scale, look at the acceptance, look at the scalability and the runway. So when I'm thinking that, the runway for a business, for the potential product and service, 10 to 15 years of growth avenue, not as, and the potential red flag will be, story built on cyclical tailwinds, or, something like a government stop. Look at the recent, the defense story or something. We know it can potentially get punctured very quickly.
Yeah.
And second thing which comes to my mind is scalability, asset light, or network effect model which comes into play, and as compared to a capital intensive and thin margin businesses. So this is also it goes without saying that there's going to be, and we tend to forget it in the daily noise of the market. We tend to forget it. Moat means pricing power, nothing else. So if you can't really, if you don't lose your customer and you're able to price it, nothing like it. And that translates into, high gross margin, rising return on capital. As compared to, when I look at startup, and, when I look at all the scaling up and, the blitz around it, and the cash burn, and, such poor free cash flow, I'm really wondering that, who is buying into it? What are people thinking? Then, clean governance, owner promoter skin in the game. And, I have lived as an owner all my life since my education. And, I just fail to understand that how many of the transactions or many of the things that I see happening in companies, big companies, I'm not talking of downright fraudulent things. I'm talking of, the general stuff, working on the gray lines, think of the pledging, think of the auditor's churn, think of OPEC subsidiaries. These are actually your, these are the leaking buckets in a company, and you're somebody who does not really believe in, shareholders as a partner, and they should not come to market to get the capital even. And then the capital allocation discipline. When I look at the previous, decade, and all the great companies which turned out to be disaster, it was entirely the equity dilution or the empire building attitude, trying to build an empire. When you look at all the 8-10 companies which went bankrupt, whether it be Bhushan Steel, whether it be Kingfisher, this, that, 10, 15, 12 companies. When I look at it very closely, at the heart of it, it is empire building, M&A or equity dilution, which translates to be careful about it. And so capital allocation discipline is crucial.
Okay.
Then, checklist habit, cash flow, not just earnings, and ensuring that, promoters are not pledging.
If you like the video, do like, comment, share and subscribe.